What is happening, traders? This is Thomas here from Vaga FX, and in this video we're going to be discussing why me and my community only use a single time frame and why the majority of retail has got it wrong when they think that multi-time frame analysis is the only way of trading supply and demand. In fact, I'm here to tell you that there is actually many problems in doing that and how these problems can be solved by switching to a single time frame style of trading. So we're going to take a look at the problems first, guys, and then we can discuss how single time frame analysis does sort these problems out. Now, the largest problem that affects multi-time frame analysis is quality. It is common knowledge that the higher the time frame, the more data is getting compressed into less and less candles. So the more compressed the data, the lower the quality of analysis you can do. You're also more likely to be trading against the true momentum of the market. Now take this chart for example. In this chart, we took our trades on the same time frame that we were doing our analysis, and we maintained our bias with the true order flow. That is, we were trading with the trend rather than against it. Whereas if we go on to a daily time frame, let me just get my rewind tool out. We go to the daily time frame. You can actually see that we were in an uptrend through all of this. We can see that there was a high broken by here. We can also see that this high was broken. So anyone using the daily time frame for their bias, guys, would have been looking for a bullish setup within this range. Whereas we know, using our style of trading, that we actually got involved in three different setups that were all against the momentum for a trader using their daily bias. But for us, now trading with low quality analysis comes with its own problems anyways, such as lowered strike rate, poor psychology from being on the wrong side of the market all the time, and obviously confusion. But it is actually going to increase the time you take marking up your charts each day, and it's also going to add complexity to your trading plan. The next big problem that multi-time frame traders have is market efficiency. Now, market efficiency is the market's ability to rebalance itself after becoming imbalanced. Inefficient price action causes large price movements as there is a lot of imbalance and the market doesn't come back to rebalance itself. Whereas efficient price action does cause ranging, liquidity building price action. Now, the problem here is that multi-time frame traders commonly use something called fractal entry points. And this is when a market reacts to a higher time frame zone, then they search for a new zone and entry point on a lower time frame. So say we have identified a nice swing demand zone at this point. Now, what me and my community would be doing is we've noticed that there's been corrective price action. We've had a strong imbalance movement. That'll be in balance at this point. We've broken through multiple structure points. We know that there is likely a very large amount of imbalance by here. That is a massive amount of buy orders as opposed to sell orders. If we drew our zone across by here, we know that the market is likely to come back down. It's likely to react aggressively, and it's likely to continue its order flow. The market obviously moves in trends. We know that if the market comes back to this zone, there's going to be so much of an imbalance by here that the market is going to react aggressively. Now, the problem with multi-time frame traders is they're going to wait for the market to come back to their zone. What they're going to do is they're going to wait for a reaction and then not going to enter. They're then going to wait for another zone to react from. Now, they'll be drawing this on a lower time frame. This will be, for example, a 15-minute chart, whereas by here they would have been looking at the hourly. And then what they'll do is the market will come back, form another reaction. In some cases, they'll go down to another time frame again, for example, the 1 minute or 5 minute time frame, and then they'll look to get involved. What's the problem with this, guys? Now, the problem is, for the markets to be reacting in this way, this is efficient price action, it means or implies that there was a lack of imbalance at this zone. The market hasn't reacted aggressively, means there's not going to be a great amount of ill orders at this zone anyway. And each time the market is coming back, it's rebalancing itself, it's mitigating the imbalance. Each time this happens, and each time the market doesn't react aggressively and continue its order flow, the less imbalance there is. So there's getting more and more sell orders at this point as opposed to buy orders. What's also happening, guys, is there is liquidity building to the downside. And the more liquidity that builds as well, mixed in with the lower amount of imbalance at this region of the market, you'll actually find that the market is more likely to actually drop the other way rather than continuing upwards. Now, as you can see, guys, and what you will have noticed if you are trading this style, is the market does still get these reactions. And that is obvious. It's just the market is less likely to continue on its long-term order flow when this happens. So you are still going to be able to make some profits if you are trading like this, but you should have lower profit targets. Just because the market is less likely to come up here, it's more likely to range around here. So I'm now going to show you how me and my community do see the market and how we are able to trade on a single time frame with higher or long-term order flow. And I'm then going to cover why it does solve a lot of the problems that we just discussed earlier in the video. So we have bullish order flow. We can see major highs being broken, no major lows being broken, and then we get a breakdown of the market. The structure then becomes bearish, performs another order flow reversal, and trends upwards. What can we deduce from this, guys? We can see that we had an order flow reversal here. We can see that there was also an order flow reversal here. This is where the order flow reversed from bullish to bearish, from bearish to bullish. If we see the peaks, so these are the absolute extremities of the reversal, guys. We know that these are going to be swing points. On a higher time frame, it would simply just be normal highs and lows, depending on what time frame you are looking at. For us, we know that they are swings. And whatever swing decides to break, we know that that is then going to determine our bias. So say we then get a breakdown by here, we get another order flow reversal. The market breaks downwards through the swing low, and then we get another order flow reversal. We pull this across, we can see that we had a order flow reversal here. This is obviously the latest swing low. We can follow the market back. We know that this is the last order flow reversal. We know that that is the last swing high. So we know that the market is now bearish, guys. The long-term order flow is bearish because of the swing low that's formed. We can follow the market back, look for imbalance. We know that this is a swing point. This is where the order flow reversal happens. This is when the orders came into the market to reverse the price. And this is where the source of imbalance lies. So we can look to target a zone. We know as the momentum is bearish, and this is where the shift in major order flow happened. But the market is likely to come back up and react aggressively to this supply zone before momentum continues. So I'm going to start by going through some of the benefits you'll get by adopting this single time frame approach to trading, guys. So the first thing is relativity. Relativity means that you're going to be encompassing all price action. You're going to be analyzing all swings, no matter how small, no matter how large. Whereas on higher time frames, you're getting compressed data. There are going to be swings that you simply can't detect, and therefore you are going to be trading against order flow more often. Now, this is going to increase your analysis quality. You're also going to be able to detect imbalance and liquidity a lot easier, which is going to further improve the depth of your analysis. And in turn, your strike rate is going to improve. And because of all this, your psychology is also going to increase. It's also easier to backtest, guys. If you've ever tried backtesting more than one time frame together, you'll know that it's either impossible or incredibly difficult, depending on what software you're using. By doing it all in one time frame, you're not only decreasing the workload for backtesting and in trading in general, but you're also increasing the speed at which you can backtest. Therefore, you'll be able to obtain a lot more data, which is going to give you more confirmation that you're actually trading a profitable strategy. And obviously, the workload and backtest capability is actually going to have a positive effect on your psychology as well. So that is it from me, guys. If you do want to learn more about how me and my community trades, you can find a link to my free community in the description, and also a link to my Instagram where I do post a lot of my setups and other content. You can also find a link to my website, which will go over the course, and obviously that will go more in depth about all the concepts and setups that we use within the strategy. I hope you all have a lovely trading week. I will catch you all in the next one. Peace out.